Washington matters a lot more to markets than markets think it does or appreciate it does. That I think is bearing itself out. You have to take the president both seriously and literally when he talks about trade. The tariff level is already high. It's around 13% right now. So these are already high. And we think that are more likely than not poised to go higher. This just, I think points in the direction of a Fed more inclined to sit on their hands than to take action. You could actually see some of these business tax provisions actually being stimulated by the end of the year. So we are penciling in, maybe 20 basis points contribution to growth for this year. We entered this, the year with a 2.22 forecast, kind of 2-ish% real growth, 2-ish% inflation, closer to 3 with a 2 handle in it and 2 Fed cuts. Now we're kind of like 1, 3, and then 0 to 4.
Hi, Libby. Thank you very much for joining us.
Thanks for having me.
As head of U.S. public policy at PIMCO, you sit at this sort of unique intersection of the markets in Washington. And I think where maybe policy meets portfolio implications and allocations. And so given the dynamic environment we have today, with all these different policy changes and things coming down the pipe, we thought it would be good to talk to you about a number of things. So the lineup is tariffs and trade policy, the big, beautiful tax bill, and fiscal policy, Fed independence, housing finance and GSE reform. And hopefully we get a chance to get to your PIMCO investment outlook and how the firm is reacting and positioning portfolios in this environment and what you're telling your clients. So thank you very much. I'm pleased to be joined by my co-host, Dave Noddick, who will help work through all of this together.
Good to see you.
So the first thing we want to kind of dive into here with you, Libby, is tariffs and trade policy. So as we get closer to this August 1st deadline, do you think the Trump administration, where do things stand on the tariffs? What's your view? Is this going to actually, are we going to see tariffs come through, or is he going to back off once again?
Yeah, sort of this idea of like tariff man versus taco man, right? Taco being sort of the meme about Trump always chickens out. I think our view, continues and has been that you have to take the president both seriously and literally when he talks about trade. And that's just because if you go back to what the president was talking about in 1985, before the Plaza Accord, he was talking about unfair trade with Japan, about Japan being a currency manipulator, about tariffing Japanese VCRs. He was against NAFTA in the 1990s. He was against China's accession to the WTO in the early aughts. So this is something he believes in. He's quite ideological about this. So I think kind of the bottom line is you have to take him seriously when he's talking about increasing tariffs on August 1st. As a reminder, this is something we keep trying to reinforce to our clients. The tariff level is already high. So even though this kind of taco, meme or narrative has gained traction, he really hasn't chickened out. If you look at the kind of the average effective tariff rate, the rate that the U.S. is charging across all its imports on an average basis, it's around 13% right now. And you see that in the customs revenue. We're actually generating a lot of revenue for the U.S. Treasury right now from tariffs. So these are already high. And we think that are more likely than not poised to go higher, whether it's August 1st or whether it's in the fall when he puts more sector tariffs on. We think that kind of trade policy uncertainty and higher tariffs are something that investors in the markets will just have to navigate over the next 3.5 years or so, if not longer.
So that was my great. So that was my next question. Is it like further escalation coming? And I guess your view is probably yes, because this is kind of Trump's, he's been talking about this for a long time.
He's been talking about this a long time. And I think unlike Trump 1.0, a couple of things. One is there's a higher pain tolerance, clearly, than there was. There was much more kind of a reaction function between the equity markets and pushback from the business community. There's, of course, still that relationship now. But I think, again, just the general pain threshold is higher than it was under the Trump 1.0. A big difference is also just who his advisors are. There's this expression in Washington, personnel is policy. And his personnel this time around are much more kind of in line with his ideology and with this sort of broader mission about remaking the global trade order. Again, I think this is, pretty ideological for the president, but also a view that is shared again, probably more widespread than it was under the first administration. The one caveat I would give to all of this is, and this is a little wonky, but I think it's actually quite important for the markets, is that the president the executive branch has vast authorities to impose tariffs without Congress. But the statute or the law that the president is using for these tariffs, the 10% universal tariffs, these potential reciprocal tariffs, fentanyl tariffs, it's something called IEEPA, the International Emergency Economic Powers Act. This is when everyone's sort of eyes glaze over, but it's actually quite important because there's a pretty high chance that this is ruled unlawful at the end of the day. And the Court of International Trade already ruled that the president actually does not have authority to impose sweeping tariffs under this authority. This is basically getting adjudicated through the appeals court. We would not be surprised if it lands at the Supreme Court. And so, come at the end of the year or the beginning of this year or next year, 2026, there's, maybe a 50-50 chance that the courts actually rule that all of this is unlawful. So again, it's kind of this caveat. Yes, we believe the tariffs are going up. We think escalation is going to be more escalation than de-escalation. But there's also a chance that actually it's the courts that end up blocking this, not actually Trump himself.
When you see the variation between countries, I mean, you mentioned right now we've got sort of a 13%-ish effective base rate. But when we look country by country at our trading partners, we've got rates all over the map, over 100% to just the 10% to 50% on Brazil. When you look at those collections of sort of shoes still to drop, are any of them particularly concerning? Are you more or less worried about the EU versus China? And as investors, how should we be thinking about this? Is this the time for us to be leaning into our international allocations? Should we be sort of holding off and waiting to see how the court cases play out? How do you think about that as an individual investor trying to make an allocation?
Yeah, so you're right. I mean, it's all quite disparate. As a reminder, it's about a 40% effective tariff rate on China, and that was down. It was and at its peak, it was 145%, which is effectively a trade embargo. That was then softened after there was sort of this negotiation. Europe, I would say, if you just look at the countries with whom the U.S. has the greatest goods trade deficit, again, kind of wonky, how much we buy from one country versus how much they sell to us. And just goods, not services, because this is sort of the scorecard that the president uses as it relates to the U.S. relative to other countries. And, who do we have the biggest goods trade deficit with? China, number one. Number two, Europe. Number three, Mexico. Number four, Vietnam. So, when we were talking to clients right after the election, I would show them that slide. I have a slide in my slide book, chart book, that sort of shows this is sort of the roadmap for increased tariffs, and where it will land and kind of where it will go, is an open question, but that tariffs are likely going to be higher on those countries with the highest goods trade deficit. I think that still stands, right? So the Europe right now, we have a 10% tariff. I would not be surprised if that were going to be going up. The president for a long time, for decades, has had an issue around Europe and trade and what have you. Vietnam, we already have this sort of, deal, or at least a deal in name. And then Mexico and Canada, we're going to start pursuing this renegotiation of kind of NAFTA 2.0 or USMCA. So I think the bottom line, again, is that the countries with whom we have the biggest trade deficit, I think, are going to continue to be the most vulnerable. In terms of how to trade this, we still like U.S. duration, despite, all of the kind of the hemming and hawing. We do, being an active manager, we like the belly of the curve versus the long end. So we still have what's called a steepener on, basically avoiding the long end and more concentrated, again, in that sort of 5 to 7 year maturity. But we also like, non-U.S. dollar allocations and kind of, outside of U.S. duration. We like Australia duration, we like UK duration. And so we are seeing value outside of the U.S. as well. So again, I don't think this is where there's a bit of a nuance between the policy and actually how you're implementing the trade. But we think kind of the bottom line here is, again, trade policy uncertainty is going to stick around, and it will likely have an effect on U.S. growth. And that will probably, most likely at some point inform, the interest rate policy of the Federal Reserve. And that's one of the reasons why we're positioned the way we are in terms of the U.S. yield curve.
Just before we move on to the tax bill, just speak to like global trade relationships and this idea of them becoming more fragmented. And maybe you just hit on some of that, but you've talked about this fragmentation era type of environment. And so can you just talk to that a little bit?
Yeah, I mean, I think that, this idea of kind of multilateralism, the World Trade Organization, for instance, being sort of this like emblem of globalization and multilateralism, I mean, I think it's sort of an overstatement to say that it's dead, but certainly on trade, we have moved from kind of the multilateral world to much more of the bilateral world. And I think Trump 1.0, President Trump in his first administration kind of ushered that in. But then, honestly, the Biden administration also continued that. So it's not like there's been this sort of big pivot from Republican to Democrat, and obviously now back to Trump 2.0. So it is all going to be about bilateralism, about these sort of, relationships between the countries, not among all these other countries. I don't think we're going to see a big free trade agreement like the TPP, the Trans-Pacific, the sort of the broader multilateral trade act that was never actually implemented because of politics back in 2015. I don't think we're going to see something like that probably for a while. Certainly not in this administration, probably not in the next administration. So, that just means that kind of this, again, less globalization, more nationalism, more populism. I think all of these things are sort of interconnected, but certainly from a trading perspective, things like the WTO, like these big kind of multi-country trade pacts, are probably, if not dead altogether, are probably taking, a long nap for a while, for sure.
So let's move on and talk about the big, beautiful bill a little bit. We've had a little bit of time for it to settle down and for people to actually start reading the 1,000 pages of it. Is there anything in it that you think is getting underreported or that you feel is going to have an impact that is probably not getting discussed? There's so many individual components of this bill, from tax policy to the new savings accounts to infrastructure. I mean, you name it, there's something in here. Now it's settled out. What do you think is not getting covered enough, or that you think is actually really important?
Yeah, it's a great question. It is a big bill. I think that the headline, kind of the big takeaways are, one, that it extends all of the 2017 tax cuts. So, we're going to avoid this kind of big fiscal cliff, if you will, if there hadn't been action on that. So I think that should be a relief to everyone, some sort of certainty. Number two is that it actually makes those tax cuts, not only extends them, and that makes them permanent. So there's even more clarity, more certainty around, from the individual side, so estate planning and all of those good things, but also from a business perspective. And I do think that's one thing that's been somewhat underreported, is just these, business tax provisions, the immediate expensing of R&D, bonus depreciation, the immediate write-off of, factories and manufacturing plants. I mean, those, not only are those sort of retroactive to 2025, so the beginning of 2025, they're, I think they're made permanent. I think that will, that just, is likely to catalyze, CapEx and what have you, and could be probably more front-loaded in terms of stimulus than I think what people expect. You could even see some of this. I mean, we were penciling in, first quarter 2026 to really see this sort of stimulus on both the business side and then the individual side, which I'll talk about in just a minute. But you could actually see some of these business tax provisions actually being stimulated by the end of the year. So we are penciling in, maybe 20 basis points contribution to growth for this year. It's not 1 point, but it's not zero either. And particularly if you're talking about a tariff drag, that could kind of help to offset it. The big kind of more, this more likely stimulus will be, though, in that first quarter of 2026, both from a business perspective, but then again, on the individual side. And that's because not only was there an extension made permanent, these Trump tax cuts in 2017, you also saw some new tax cuts, whether it's no taxes on tips, no taxes on overtime. There's an increased deduction for senior citizens. There's no taxes on interest for auto loans for certain income cohorts. So all of those things, and they're all made retroactive to 2025, meaning that when folks are filing their 2025 taxes and they're getting those refunds from 2025, they will get some benefit of this. So, I think the bottom line here is not only is there kind of certainty and tax clarity that was, infused in this bill, but there's also probably some more front-loaded stimulus than folks were maybe expecting, and that I think has been written about, or that I've seen like sort of sell-side economists, pencil in from a growth perspective.
Does the 2025 sort of recharacterization around things like expensing R&D, CapEx, does that have the impact of sort of immediately juicing earnings? Are companies going to be able to take advantage of that effectively in their current fiscal years, or is this going to have a little bit more of a lag on it?
Yeah, I mean, this is where I think we're also trying to parse out. I mean, again, not to get kind of too wonky here, but there's a provision. So for most big companies, the R&D, immediate expensing of R&D goes back to 2025. For smaller companies, though, for those with revenue less than $30 million, they actually get to retroactive that immediate expensing back to the end of 2021. And so if they have if they have a enterprising accountant or a CFO or finance person, they will be able to take advantage of that, pretty quickly in sort of the second half of this year. Now, there's also, again, kind of wonky, a little bit of a lag in terms of when the bill is passed and then regulations that implementing regulations. Something that maybe folks don't appreciate is that the IRS has to actually write the tax regulations that then, give guidance for how people should take advantage of them. So if this isn't immediate, people can't do this tomorrow, but we could certainly see regs being issued in kind of the fall timeframe. And again, that could be taken advantage of, particularly from on these smaller companies, more immediately. So again, the boost, we still expect the main boost to come at the end of the year, if not the beginning of next year. But you could see sort of this bleed over into kind of third quarter, depending on how fast the IRS can write these regulations.
And on the downside, I mean, is there anything that's surprising that isn't going to be positive here? We've talked about pulling forward a bunch of the stimulus.
Yes. Well, a couple of things. One is there's the deficit impact, right? So, I mean, if you look at over 10 years and everybody loves to bash the CBO and the JCT, which is kind of the nonpartisan scorekeepers. It's certainly not perfect, but it's kind of the best things we have. If you look at their scores over the next 10 years and you add interest expense, this will likely add about $4 trillion to the deficit over the next 10 years, or collectively to the debt, to the deficits, or obviously the annual kind of benchmark. A lot of that deficit impact will be front loaded because a lot of these tax cuts are more front loaded. These new individual tax cuts, for instance, expire at the end of 2028. So the deficit impact is going to be more near term than longer term. So that's one implication that's not great, right? If you're worried about kind of fiscal profligacy, if you're worried about, Washington not getting that together, this is definitely not reassuring. I think largely this was priced into yields, though, going into this sort of tax debate and kind of coming out of it. So I don't think you'll probably see a lot of yield action kind of following it, but certainly this is, adds upward pressure, particularly to that long end, that kind of term premium, if you will, at the longer end of the yield curve, something that we've been trying to avoid here at PIMCO. The other, big implication from the bill, which could potentially be negative for growth, is just the fact that there are cuts associated with this bill, particularly in Medicaid, that affect the kind of the lower income cohort. Those are not effectuated, though, until 2027. Pretty smart because they kind of push out the pain. You're going to kind of characterize this as vegetables and dessert. The vegetable, you're having your dessert first and you're pushing off when you're kind of pushing your vegetables around the plate, so to speak. And so the vegetables are delayed. the IRA cuts, the Inflation Reduction Act cuts, obviously a huge green tax bill. Many of those are going to be kind of unwound, but again, also delayed in terms of when that's effective. The kind of runway to take advantage of those provisions has been extended as part of a way to get some of the moderate Republicans to vote for it. So it's certainly not all dessert for, at all, deficits. And then again, some of these spending cuts and the rollback of the IRA. So depending on kind of where you're investing, I think green investors are obviously going to feel this the most.
One of the things that's getting kicked around a lot, which I know I don't know a ton about, but I'm fascinated by, is the return from conservatorship of our two big mortgage buyers in the world, Fannie Mae and Freddie Mac. There seems to be this heavy push to re-privatize them, right? To take them back into publicly traded securities that you can buy somewhere other than the pink sheets. You wrote, I thought, a great piece on this a few weeks ago, where you just sort of highlighted the fundamental, well, I guess we're going to go back to socializing all the losses and privatizing all the gains. I think the largest shareholder of the outstanding securities, again, trading on the pink sheets, is Pershing Square. So who wins in this other than Bill Ackman if we actually spin this back out into the market? I mean, he's already up 50% in the last couple of weeks just based on the rumors here. So walk us through, how likely is it that this happens? And what are the real implications, both for homebuyers, right, who ultimately are the ones taking down mortgages that get bought by these entities and guaranteed by these entities, us, the taxpayer, and also for investors, right? If these become, viable portfolio securities again, should investors be piling on the day these things come out of conservatorship?
Yeah, I mean, just as a reminder for those people who are not as familiar, this has been an issue. I've been at PIMCO for 18 years, and I feel like for the majority of that time, I've been following this issue or engaging with Washington on this issue. Obviously before the financial crisis, these were kind of these like hybrid entities, right? As you said, there were, private shareholders that, owned them and were able to reap the profits and the benefit of what were very profitable companies. But there's always sort of this wink and nod, this kind of implicit guarantee, if you will. I mean, I put that kind of in quotes, that these were basically too big to fail. And so they were able to borrow very cheaply, basically at, the same rate the government was able to borrow. And there was always this kind of, again, this assumption that should something happen, that there was this guarantee. And of course, something did happen. And they effectively went insolvent as private companies. They owned a lot of stuff that, looked very kind of juicy and tantalizing from a return perspective that ended up not being money good. They had this on their balance sheet. And then they were taken in conservatorship, or basically made part of the government, at least kind of temporarily. The view at that time was that conservatorship was not a permanent state of affairs, that it was kind of this, supposed to be this temporary state. And in the process, a new regulator was set up called the Federal Housing Finance Authority, or FHFA. They were cleaned up. Their balance sheets were cleaned up. They were much more trimmed. What they were doing or allowed to do was really scaled back. And they kind of got back to their roots, if you will, which is to provide liquidity to the secondary mortgage market. They buy loans from originators, they wrap them in this guarantee, and then they sell them to the PIMCOs of the world or what have you on behalf of our clients. And the mortgage market as it is the deepest, it's the most liquid, it is the most reliable in the world. I mean, we really do think the mortgage market is kind of the envy of the world, and Fannie and Freddie have a huge role to play in that. So that's why when we think about this sort of privatization, going back to where they were before the financial crisis, it's difficult to imagine that this kind of implicit guarantee, we don't even know what that means, right? At this point, it's either something's explicitly guaranteed, you're part of the government, or you're not. JP Morgan, for instance, is like a very well-capitalized, well-run company, but it still trades with credit risk because it could still go bankrupt. It is not part of the government. And, our view is that even if Fannie and Freddie were released with a lot of capital, they'd still need to raise a lot more capital than they have. But even if they had a lot more capital, they would still be perceived as having credit risk, meaning that, you're not only does their product, the agency MBS, trade with duration risk, they would probably trade with some credit risk. And that just changes for the borrowers. That changes the borrowing rate, right? That means that there will likely be upward pressure on the mortgage rates. That's, we would argue, not great for home buyers, probably not great for the housing market, and probably not great for the economy. So, our view has been one that we're a little bit skeptical that this will actually happen because of this. And if it really were serious and folks were really, really focused on releasing them, we would argue that you would need Congress to step in and provide an explicit government guarantee on the agency MBS in order to ensure that the MBS does trade like with the interest rate risk, not with credit risk as well. We think that sort of short of Congress providing explicit guarantee, mortgage rates are going to go up if they are released. Now, the question is how much and how far, we don't know, right? That's kind of anybody's guess. But our view would be that it's sort of inevitable. If you're no longer part of the government and you don't have a guarantee, you're probably going to be having to compensate investors more with some sort of risk premium, and that means higher mortgage rates. So very long way of saying, I think we think it's unlikely. If this is really, a serious effort, there are lots of things that need to start like right now. One is something called the Uniform Mortgage-Backed Security. It's something called single security. Basically, the idea that you issue one security and the collateral is Fannie or Freddie, or Fannie and Freddie. That doesn't exist in a private market, right? You don't have one security and Goldman Sachs and Morgan Stanley debt backing it. So that would need to be unwound. That took several years to be put into place in the first place. You need to have the banking regulators likely issue some regulation about how agency mortgage-backed securities post-conservatorship are treated on the balance sheet. So, this is kind of wonky, but I think these are the nuances that get lost in our view when folks are talking about privatization. There are just lots of things that need to happen beforehand. Plus, don't fix what's not broken. If you want secondary mortgage market liquidity and mortgage rates are like already, you're worried about housing affordability and mortgage rates already being high, we don't think this likely will help.
Well, and we've been making money. Like the taxpayer has been making money on this deal, right? These are enormously profitable enterprises. Supposedly, we're due hundreds of billions of dollars on the ownership of these things. What would you look at as the signal that, oh no, we're really going to do this? Like, is it something like sort of restructuring one of these agencies? Is it somebody actually putting a proposal on the House floor? Like, what is the signal where you would change your mind and be like, oh, I guess we're doing this now?
Yeah, I think it would be there would probably need to be a roadmap issued by Treasury and FHFA about all of the things that they need to do. One is that they would need to change like the capital requirements for Fannie and Freddie. Those are relatively high, and I don't think we would say too high, but they probably would need to change, just practically speaking, if they're going to be released anytime soon. Again, you're probably going to need to have some sort of rulemaking on this UMBS issue. You're probably going to need a rulemaking on the banking issue. So I think if you're starting to see real movement on all of those things, and again, we would hope that Congress would step in and provide an explicit guarantee if this were really, actionable. I guess, that's a lot of coordination. That's a lot of, is the squeeze worth is the juice worth the squeeze, if you will? Because it's like
for the amount of energy it would take. Well, it would be for Perkins Square, but for the rest of us. Yeah.
Right. And no comment on that. This is a family broadcast.
Hey, people got to make money. Yeah, no, I get it.
Yes, exactly. But I think that, just to leave on this point, because I think this is really important though. At the end of the day, is it good for borrowers? Not really. And is it good for the taxpayers? Probably. So even if the taxpayers can monetize at $300 billion, which by the way, would be the biggest IPO in the history of the world. So I believe the biggest IPO ever was the Aramco IPO and like sub $30 billion. They're talking about $300 billion. Like, that's a big IPO. Not sure which institutional investors are going to be interested in, buying all of that common equity for basically what is a utility,
Right.
That is, I mean, Fannie and Freddie are effectively utilities, and I think we want them to be utilities. They're providing a public good in subsidized mortgage rates.
Yeah, they're the engine of the ownership society.
Let's just pivot to the Fed real quick. And I want to kind of tie in, I want to go back to the tax bill for a second and just ask you if some of that stimulus is being pulled forward, and that's probably, possibly good for growth. Like, what type of position does it put the Fed in here? I mean, if you're seeing that happen in late 2025 and early 26 with this stimulative effect of the economy, and the Fed is possibly, I mean, I don't know. I mean, they're now saying a July cut is off the table, but clearly there's talk about cutting soon. So just what's your sort of overall view on that?
Even, needless to say, we think the Fed's in a pretty difficult position. I mean, this is, they are obviously, Chairman Powell in particular is, thinking about and probably worried about his legacy at the margin. But worried about inflation expectations picking up, obviously inflation picking up because of, potentially the pass-through effects to tariffs. We saw a CPI print this morning that sort of indicated that like some of these tariff effects are already, coming, being passed through. And, we think there's more to come. We entered this, the year with a 2.22 forecast, kind of 2-ish% real growth, 2-ish% inflation, closer to 3 with a 2 handle in it and 2 Fed cuts. Now we're at kind of like 1, 3, and then 0 to 4, meaning 1% real growth. A lot of that's because of tariffs, and some of it's because of immigration, 3-ish inflation, and then anywhere between 0 and 4 cuts, meaning that the Fed could sit on their hands for a while until they see kind of real cracks in the economy in order to feel like they have the green light to cut, meaning that they may not cut this year. Another scenario is that they feel like they actually have to cut, more dramatically because maybe they're worried about being on their back foot. So again, this is not an enviable position. Obviously, tariffs are a tax. Someone has to pay that tax. In previous tariff regimes, it's been the consumer. So we'll kind of, I think that the Fed is just waiting to see how, a 13% effective tariff rate is going to work its way through the economy. So our view has been very low percentage odds of a July cut, and then it's going to be pretty data dependent. But this is a difficult economy. And then to your point about the tax bill, then you kind of layer on this new stimulus, potentially new stimulus that, it may not be inflationary. CapEx can be actually, productivity enhancing, and that means it's like good for real growth, but it could be. And so I think points in the direction of a Fed more inclined to sit on their hands than to take action, at least, sitting here in July of 2025. That certainly could change come September. But one that's going to be, I think, a little bit more wait and see because of all these cross currents in the economy.
Do you feel, you mentioned the tariffs as a source of inflation. You obviously mentioned potential stimulus as a source of inflation. You mentioned very briefly immigration as another potential source of inflation. And without getting into the politics of immigration policy, what's your current forecasting for the current immigration environment and its impact on prices, particularly obviously in the narrow sectors where we know we're going to have impacts like agriculture, services, et cetera, construction?
Yeah, I think, our economist team has viewed immigration more as like a growth story than an inflation story, meaning that, the moment that an immigrant comes into the United States, right? So a migrant gets over, claims asylum, gets asylum granted, and is then waiting for the court process to adjudicate that asylum claim. Sometimes takes like years to do that. They start consuming, right? They consume shelter, they consume clothing, they consume food, and they're generating GDP activity. So that's like from day one. The workforce, which is definitely has also been, and it was a kind of a boon to Biden's economy, honestly, even though politically it was a massive liability for him, it was a positive from an economic perspective, if you just look at the sheer numbers. So we think it will have less of an impact on a broader inflation. But to your point, it could have some incremental inflationary impact on, wages in hospitality and wages in construction. I think you're already seeing that maybe a little bit. But that will be more incremental. And again, we think more dwarfed by the downside or the headwind to inflation. We were already penciling in a little bit lower of a growth estimate coming into 2025 because of this immigration story. Because even though Trump has, effectively, shut down the border, you would actually already seen border flows really taper off in the second half of last year when Biden, I think, too little too late if you're just like looking at the election result, but decided to kind of close or slow migration. And so we were already penciling in some headwind from a growth perspective. So bottom line, again, we think this is, again, more of a headwind, more of a growth to growth than it is going to put upward pressure on broader inflation. But you may see some pockets of wage pressure because of this.
I'm not surprised of most of the things that Trump says, but I must admit, 2 months ago when he started calling for the firing of Jerome Powell, it was just sort of a shock to me because I've always found Fed governors to be isolated from this political sort of arena. And so I guess, I don't know, how did you feel when you heard that? And do you think there's any risk to the Fed's independence, or is politically and legally that not even feasible? I just one more point. I heard some agency guy on, and I don't know who he was, but he was kind of charging Powell with a crime or something because he renovated his office or something. So I'm this is kind of getting out of hand. I'm not sure. So I'm just wondering what your take is on all this.
Yeah, that's actually Director Pulte, who's the director of FHFA. That to our previous conversation about GSE reform, he's the guy who oversees Fannie and Freddie. And he's probably been kind of the tip of the spear in terms of some of the kind of Powell criticism and what have you. Was I surprised? I actually wasn't. I mean, not to sound like we knew this was going to happen, but if you just look at what President Trump did back in 2018, right after Powell, he nominated Powell for the chairmanship, and Powell got confirmed. He was already jawboning Powell then. He was already telling Powell that he needed to cut rates. So in some ways, the sort of jawboning, the rhetoric around the Fed, I don't think we were surprised. Maybe the, kind of the enthusiasm or the passion behind it's been a little bit surprising, or the durability of it. But I think we were expecting some angry tweets and what have you. And the interesting thing is actually, if you look at kind of over the context of modern history, it really wasn't until Bill Clinton who kind of established the norm of not jawboning the Fed, that where we actually saw a president really try to be completely hands off. If you actually, of course, Nixon and Burns, that was the most extreme example in modern history. But even, Reagan and Greenspan, George H.W. Bush actually blamed Greenspan for his loss in 1992. So in some ways, this norm of, not jawboning, of really, honoring the independence of the Fed, while we as investors welcome it, right? We want a completely independent central bank devoid of, political pressure. It's kind of a new political norm, if you will. So in some ways, Trump is just taking us back to the 80s and the late 70s. I think that the bottom line, though, is we continue to think that the Fed is independent. We do not worry about Fed Chairman Powell being fired. President Trump has said he's not going to. Secretary Bessent said he's not going to. So we have to take them at their word. And then I think even if he were, it's kind of self-defeating because the Fed right now is fully occupied. So if he fired Chair Powell, it would mean he would have to elevate somebody else from the Fed board to the chairmanship. It's probably not going to really help him very much. There's nobody who's really viewed as really political. And then even if he were to nominate somebody to replace Powell in that context after firing him, I think it'll be very difficult to get anybody confirmed, particularly anybody who's perceived as having an iota of political leaning. So, my view and my kind of what we've been talking to clients about is the more that Trump politicizes the Fed, or his administration politicizes the Fed, the harder it may be for him to get his own Fed nominee through. Because remember, to get anybody confirmed takes 50 votes in the Senate. Republicans right now have 53. But really importantly, and one of the casualties or outcomes of the tax bill is that Senator Tillis from North Carolina has decided not to run for re-election. Why does that matter? He's a Republican. He's the deciding vote on the Senate Banking Committee. Any Fed nominee who has to get to the Fed or to the Fed chair has to go through the Senate Banking Committee. So now Senator Tillis is kind of a free agent and doesn't have the best relationship with Trump. So this is where I think that folks are underestimating kind of how conventional and maybe how difficult the Fed nominee process will be for Trump, particularly if he continues to politicize the Fed. The last thing I will say is that, remember, back in 2018, 2019, 2020, President Trump didn't get a lot of the folks he wanted to on the Fed. He didn't get Judy Shelton. He didn't get Herman Cain, Stephen Moore, Marvin Goodfriend. All of those were Fed nominees or close to Fed nominees that Trump wasn't able to get through because they were viewed as sort of too political, kind of too much doing the president's bidding. Similarly, President Biden didn't get Sarah Bloom Raskin through. So this isn't like a new thing that the Fed noms are viewed as like it's a more difficult process than I would even argue a cabinet secretary is. People in the Senate really do view the Fed independence as sacrosanct for the most part, and want to uphold it.
So it sounds like more noise than action, probably for the next year at least.
Yeah, I mean, Adriana Kugler's term is up in January, so that'll be the first time he'll have the ability to put anybody on. And then it's Powell's, whose chairmanship is up in May. He could theoretically stay on until January of 2028. That's when his governor term is up, but I doubt he will. Usually when the governor's chairs are up, they usually leave the Fed. They don't really stay on typically.
I'm pretty convinced this is the first podcast I've done with someone that I think has a photographic memory, because your ability to remember all these names is pretty amazing, actually. I can't even remember like the guy I met yesterday. Anyways.
That's my job, though. So I have to do this forever.
So let's just as we get to the end here, let's get into the current PIMCO investment outlook and how has maybe it shifted or changed over the past 6 months at the firm level, high level?
Yeah, I mean, I think that, we were probably of the view more than a lot of folks that Trump was going to put tariffs on. So, we came into the year with a little bit more duration, a little bit more of a defensive posturing in terms of our portfolios. We've liked agency mortgage-backed securities. We really like them now. We continue to like them. We assume that they will stay in conservatorship, but they basically give, higher yield than Treasury, with, effectively the same backing. So as of now, again, we don't expect that to change. We are, I think, we're a bond shop. So, we're kind of bond managers. So we do think of like the glass half empty oftentimes, not necessarily glass half full. But, credit spreads are still tight. And so we've been avoiding, kind of credit broadly, but specifically in those sectors that we think have been more vulnerable to tariffs and to some of the immigration shortages. So housing was an area that we were, kind of, reluctant, kind of underweight, if you will. Healthcare has been an area that we've been sort of, a little bit more nuanced in terms of our thinking, with the anticipation that there would be some Medicaid cuts and that could hurt hospitals. And then, we've liked, energy, traditional energy that's, often, quite priced in, but then also, financial. So, I think on a credit selection, so kind of broadly speaking, we've been avoiding credit, but where we have been taking credit exposure, we've been pretty, sort of specific in terms of thinking through winners and losers, particularly as it relates to sort of Trump's Washington. And then, as I referred to before, we have been taking kind of more of a holistic or global view in our US based portfolios. We like US duration, we like the real yields, but we also like, Canada and Australia. The Japanese, curve looks a little more interesting, certainly than it did, particularly on the long end. So we think there are actually some really interesting opportunities. I mean, we obviously were active managers, so we would say this is a really compelling time for active management, where there are going to be winners and losers, and maybe the beta is less compelling, but you can again kind of take advantage of some of these mispricings and overreactions and policy headlines.
You mentioned a couple of the credit sectors you're less excited about. Healthcare obviously makes some sense. Despite the sort of rearranging of the pieces on the board, we haven't seen a huge spike in defaults, right? I mean, the reality is the credit markets are pretty sanguine in terms of people actually going bankrupt and not paying back their bonds. Is there any part of the market where you feel like this is where we might actually start to see cracks? Is healthcare it? Would we need to see the effects of Medicare roll through, say, various hospital systems and various bonds that are backing certain build outs and those individual credits going bankrupt before we actually see anything? Because despite all the hand waving, the bond market seems awfully safe. We're not seeing folks not paying.
No, that's absolutely right. And I think that in the kind of the IG space and even like the higher quality, high yield space, that's absolutely right. I think if you talk to some of our CIOs, they would probably say that it's not necessarily in the public credit space where you may see some fragility. It could be in the private credit space, particularly because a lot of that stuff is marked at par. And I think some would argue that it's probably not par given some of the headwinds. I think in some ways the private market has been able to absorb some of those, those credits in the public market that would be looking more fragile should they be, having to issue in the public market. But because there's another kind of a release valve, if you will, that's made kind of the public markets in which we primarily invest in, I think probably safer and probably more money good. I think we're just talking more about relative value, and where you just, these credit spreads are still pretty tight. I mean, they're a little bit wider, but if you really are going to see a more kind of slow growth environment, if you're going to see more tariff policy uncertainty, more headwinds from both tariffs and immigration, notwithstanding some of the fiscal impulse from the taxation, we don't necessarily know if credit spreads really reflect that reality. So, we take kind of macro beta views, but then also, again, kind of more of a nuanced view in terms of winners and losers.
So that's great, Libby. Thank you so much. We have two standard closing questions we like to ask all of our guests, and you can keep your policy hat on or you can take it off. It's your call. So the first one is, what's the one thing you believe about investing that you think the majority of your peers would disagree with you on?
Oh, gosh. I'm biased here, but I probably would say, and I think this has been borne out, but if you had asked me this question, 5 or 10 years ago, I would have said that Washington matters a lot more to markets than markets think it does or appreciate it does. That I think is bearing itself out. But I still think, that is probably true and probably underappreciated. Just how much Washington can have both a macro and then also micro effect.
And the last one, based on your experience in the markets, if you could teach one lesson to your average investor, what would that be?
Probably just staying invested. I think that's, that's a rule of thumb that, a lot of folks talk about, but that, this, whether it's fixed income or whether this equity market, obviously very difficult to time the market. And your horizon matters, right? We have the benefit of having, very long-term clients. So we're able to invest for the long term. We're able to take a little bit of, liquidity risk premium, for instance, because of that. So I think for a retail investor, obviously just staying invested, depending on your time horizon, and sort of maybe thinking like an institutional investor and not necessarily reacting to every headline as a result.
Great conversation, Libby. Thank you very much. We really appreciate it.
Yeah. Thank you so much for joining us.
Thanks.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.